Is it just inflation or a plethora of macroeconomic forces driving the tech wreck? What about top-performing companies that are growing, beating on earnings, and adding customers? Do these companies deserve to have their valuations fall by 25, 50, or even 90%? I talked to Five9 CEO Rowan Trollope about what is dragging on tech, why is the solution going to be tech to so many problems, and why are good companies still good companies even in a down market? And as a bonus, we talk about the crypto fall and is crypto going to make a comeback? All this and more on this week's Making Markets.
This is the Making Markets podcast, brought to you by Futurum Research. We bring you top executives from the world's most exciting technology companies, bridging the gap between strategy, markets, innovation, and the companies featured on the show. The Making Markets podcast is for information and entertainment purposes only. Please do not take anything reflected in this show as investment advice. Now, your host, Principal Analyst and founding partner of Futurum Research, Daniel Newman.
Rowan Trollope, CEO, Five9. Welcome back to Making Markets.
Hey, Dan. Good to have you. Good to be back. Thank you.
Good to have me. Man, what a crazy time it is in tech. And, you've been on the show before. And when I started the show, what I love to do is bring folks like yourself, CEOs on right after earnings, say, hey, let's talk about how it went. Let's talk about all the news, the excitement. Let's talk about what maybe the market isn't seeing and paying attention to. But frankly, I started this thing like in, early 21 when tech was on fire and it was just so many smiles and cheers and happies. And then November came. And since November, it hasn't been so happy and cheery. And since maybe March, April, the rest of the tech world that wasn't part of that first wave of, growth annihilation is starting to catch up. And then the indices fell and blah, blah, blah. And here we go. So, but at the same time, this quarter, tech still was pretty good, Rowan. And so you guys just reported and had really good numbers. So before I go in on my bandwagon and my soapbox about kind of how tech is not being properly valued right now, tell me about the last quarter, because despite all the negativity, Five9 doing really good.
Yeah. Well, we could debate about properly valued, I guess, but we had a great quarter. We signed the largest deal in the history of the company, $44 million, one deal worth $44 million ARR, annually recurring revenue. And, we beat on the top and bottom line. We're a company, we're growing in the 30s and, our EBITDA is in the teens. We've been a company that's not only consistently delivered beats on the top and bottom line, but also we've always had a focus on bottom line performance. And I think what's shifted certainly in the last quarter has been Wall Street now looking much more towards your bottom line than your top line and saying, what are your returns going to be? And when are we going to see, profitability and so on? And so it's nice to be in a profitable company. And that's, that's kind of where we are, and investors are rewarding us for it. Although of course, like everyone, we've taken a major whack to our stock price, right? Like 50% off in the last, whatever it's been, 6 months, or more than 50% for some companies. But that's a different matter. That's just how Wall Street values companies. I mean, at the end of the day, my job is to keep growing the company and keep delivering for customers and shareholders, which is what we keep doing consistently. So,
I mean, you got top line growth, you've got bottom line growth, you've got revenue expansion, you've got deal size growth, you've got retention rates sitting up high. I mean, from afar, I look at this and say, Five9's on sale. If I was an outsider looking in at this thing, Five9, seeing the price fall, it's a bigger company than it was a quarter ago when it was trading higher. It's got more revenue, more customers, more success. And by the way, everything we're seeing in terms of discounting, whether it's Amazon and Microsoft or it's Five9 or it's Zoom or it's any, has a lot more to do with the macros. So I just want to be really clear. It's the macros. It's the inflation data. It's interest rate hikes. It's discounting future growth. It's supply chain woes. It's war issue, concerns about the war. It's political. It's what's going to happen in the midterm election. I mean, these are the things I think that are really driving it, because you and so many of your fellow tech companies had robust earnings, and even the ones that were bad were like, that would have been okay in any other period besides coming out of the last 2 years.
Yeah, well, it's certainly been a bloodbath in the markets, but I mean, I don't think it's all of those factors. I think it's one a really important factor, which is interest rates, and we've been in this historic, strange position for a long time of essentially zero or even negative interest rates, and in that kind of an environment, you know, where money got forced into equities basically. There was a saying on Wall Street, like there is no choice. Like there is only one thing to do, and that is to invest in equities because you couldn't get returns anywhere else. And so, that is unwinding. And frankly, that's a good thing in a bunch of ways because, when you have these like long bull run expansions, what ends up happening is like, the market is awash with capital. We printed record amounts of money. That money is getting put to work in companies that fundamentally like either shouldn't have been companies, right? Or like it got misallocated essentially. That like there's so much money being given to so many companies, and a lot of waste, and like companies that ultimately now are going to get stressed and go away, and they probably should go away. But it leaves the durable, real businesses in a better state at the end of it. So it's actually a good thing for a company like Five9 and for real companies and real entrepreneurs and real business leaders to thrive, frankly, in a market where a lot of this sort of the nonsense gets washed out.
Yeah, well, I think there's an importance to decouple. I mean, you said it wasn't all the factors. I would somewhat disagree, but I understand what you're saying. The thing that moved the market the most in November fall almost came instantaneously when the commitment to raise rates came out. I just mean the longer sort of tail and then the continued headwinds of things like supply chain, political environment,
Yeah.
gridlock in Washington, no infrastructure, no more stimulus. I'm saying it kind of is, they're all little parts and pieces, but discounting growth, especially like you said early on, companies with no profits, those companies got smashed first. And then you had companies that basically in the wrong sectors that, clearly when, discretionary dollars dry up, you're like, oh, that company's going to be in big trouble. And you made a point that I've tried to make, and I think you said it very eloquently, but effectively a whole bunch of features became publicly traded companies instead of actual solid, robust companies with potential and growth and earnings. And by the way, some companies just got mixed up in that because, like SPACs, we talked about that offline. Everything that's a SPAC was negative, and not all SPACs are bad. But the point is that just the general perception of it has become so negative that basically every company in that particular space has probably seen anywhere from 50 to 80% washouts. But talk a little bit your growth, though, because I think what you said is really the key thing. As a CEO, continue to grow the company, focus on customer, focus on net revenue expansion, product development. Do those things, do them consistently and over a long tail, which is what investors, not traders, but investors really think about. Is if you just kind of don't look at your portfolio, you're going to come back and be rewarded if you do those things consistently over various market conditions. What are the secular trends that you think are your tailwinds at Five9?
Well, clearly the cloud transition is one of them. That's probably the biggest one. As all these companies, if you ever call into a business and you get terrible service, like the odds are they're using, a dusty phone system in a closet somewhere that hasn't been upgraded, and the agents are probably typing on like green screens on like DOS prompts and stuff like that. Still exists. It's like more common than you would think, actually. And in fact, most companies are still in that state. So we're at the beginning of, a transition off of those legacy phone systems onto modern cloud CCaaS platforms, so contact center as a service platforms like ours. And like where most of the industry really, this is the tail end, I would say, of the B2B SaaS transition, or in some ways, like maybe, I don't know if that's the right way to say it, but like you had a huge first wave, which was the CRM platforms. Like think about Salesforce went first, right? They created the SaaS category in a way and certainly popularized it. And, those systems went first. The real-time systems like contact center, which is a real-time platform, we deal with real-time voice and it's all through the web browser and blah, blah, blah. Similar to the rest of the real-time collab space, those technologies needed more robustness and reliability in the internet than we had 10 years ago. Like this experience we're having right now, where we're like probably both on Wi-Fi and we're sitting on our home internet connections and you're getting like crystal clear audio and video, hopefully. That was not possible 10 years ago.
Hopefully.
Yeah, hopefully. Yeah, that wasn't possible 10 years ago, but it is today. And that shift has really enabled people to take their on-premises contact center systems and go, well, we don't have to maintain this, this big iron, rack and stack hardware to do this. We could actually use a cloud service. So that's the big trend driving it. The second big trend driving our business is actually three. The second one is a generational shift away from sort of like old guys like me and you who are like kind of, we grew up being used to, you want to get support, you pick up the phone. Okay, that's what you do. Now, we didn't like it, but it was what you were used to, right? And you tolerate the IVR and all that nonsense. Like my kids, I don't know if you have kids, Dan, but like our generation, 3 kids, like that generation of kids and younger millennials coming into the market, like they grew up with like the expectation of texting and online web and everything else. So like the idea of calling into a call center, it's like, that's not something that my daughter is probably ever going to do in her life, period. And so that's driving the big shift as well, is that like, you cannot get away with doing what you did for so many years. You have to modernize that platform and give your customers a better way to engage, which is usually like online and self-service and digital channels first. And then the third really big trend driving our business is the labor problem, which is, to the degree that most of the contact volume is still being handled by human beings, those human beings are becoming more expensive, harder to find. And so AI and automation, like customers are coming to us saying, how can you help us like automate even more than we've automated before? And we have invested early in this trend. So we're a market leader in AI and automation. We've acquired a company called Inference, and it's basically helping customers get more efficient with their labor, which essentially means taking some of that high volume but low value contact center traffic off of the plate of the human beings and letting the computer handle it, so that the human being, either you need fewer human beings or you put the existing people that you have onto doing things that are more interesting. So those are the three trends driving our business.
It's actually quite a secular tailwind you actually have. I've written, I'm published publicly, said a million times, I believe enterprise tech will hold up extremely well despite a lot of the external factors, because companies are going to make investments in cloud, 5G, SaaS, automation, things that are going to make their businesses more efficient, more effective, things that'll maybe move some CapEx to OpEx spending, streamline business performance, monitoring, analytics, AI, all those things. And by the way, you're in almost all of them, which works out really well for you.
It doesn't matter what happens with the economy. Businesses are not going to undigitize. That is not the way of the future. Like that's just like, it's not going to be like, well, things got tough, let's go get an old phone system, from like some telco or something, and maybe we can. That's not how it works. It's the opposite.
Well, in a recent sit down I had with Arvind Krishna, the IBM CEO, he actually said, one growth number you can count on is that tech growth will always be higher than GDP. And it's, more or less, I'm paraphrasing him, so I want to be clear about that. But the point that he kind of made is that, if you want the biggest proof of the deflationary aspects of tech, it's the fact that it just almost has to grow faster than the economy. Because the only way the economy grows is on the back of tech. And so to wrap up our conversation, the question I'd love to ask you is, I keep saying that we've got to tech our way out of this. Okay. So meaning that you mentioned a tight labor force. You've mentioned the supply chain. You've mentioned, and we haven't specifically talked about, but even things like abuse and misinformation, the spread of abuse and misinformation on social media. If you look at companies being able to execute their ESG commitments to the world, I don't see any other investment that enterprises can make that will provide a higher ROI to meeting these objectives or to fixing these problems in the world than the investments in tech. Other than maybe the people required to deploy them, what other options do companies have which, by the way, and I just want to get this out, but is exactly why I say no matter what the craziness of the market and the day traders do and the gyrations and volatility, in being in tech over the long run is going to be a winner, especially in the right. I mean, you got to pick the right companies, but the right ones that are doing what you said, performing, growing, delivering great customer experiences, hitting margins. Where else would you want to be?
Yeah, I think it's important that people don't get distracted by what happened in, I don't want to call it a bubble, but like, over the last 10 years where money became cheaper and cheaper and it funded a lot of nonsense. Um, like you can't throw the baby out with the bathwater. You can't look at that and go, well, there was some crazy dumb things that got funded, therefore like all of the funding is bad. There's actually like tons of amazing, it is pretty obvious, right? But like there's tons of amazing companies that have been created over the last 10 years, that are like real companies in the tech space. And it's, what'll happen over the next, period of time, however long this sort of downturn lasts, 1 or 2 years, something like that, is a lot of that nonsense will get washed away. And you'll see the real durable, what are these real companies that are actually like awesome assets to own? And maybe they're, look, over the fullness of time, those companies that are going to survive this are incredible buys right now, right? And like, depending on how long out you look, like what's your horizon for returns, but like, as long as you're thinking about the long enough horizon of returns here, all these are probably, some of these are good buys at this point. I certainly, I'm a holder in our own company. I think, again, over the fullness of time, when you have a company that's growing 30% in the 30s year over year consistently and profitable, that's going to be a great investment. And whatever the starting line is, okay, so the starting line is lower now, but ultimately it's still, it's better when you're not looking at this market from my perspective and saying, when's the air going to come out of the balloon? Like now the air has come out of the balloon. I don't know, maybe it'll go out even more. That's possible. But I want to be operating from a place of like a sensible investment environment where people are making investments on real companies, on real like future returns, and not a bunch of nonsense that's clouding the air. And that's a better starting place. So in a way, it's like, whew, thank God that's over. Now we can get back to like people just making sensible investment decisions in real companies.
Yeah, until we do it again, because like every decade
Yeah, it'll happen again.
Really stupid. We blow up the balloon and then we pop it and then we all go crazy. The psychology of this is real. It's hard. I mean, like I said, the reason most of us don't do as well as we should is because when it actually gets really bad, the whole Buffett, like buy when there's blood on the street, or that whole kind of thing, like we all get a little paralyzed. Like instead of actually going, most people, not all, but most people actually, they contract, they pull their money out, they take their chips down. And that's, for instance, and I'm going to ask you this, we're going to end on this, Rowan, but I've seen you've had laser eyes. I've seen it on your Twitter profile. So you're clearly a crypto guy. It's easy after seeing the Terra Luna story, Bitcoin falling. I mean, I'm a big investor in Solana. I'm a believer in XRP. I'm in Bitcoin and Ethereum because those are the core holdings of any portfolio. But my point is like the last week I saw more anti-crypto people come out. Every expert on the planet, every 75-year-old or older Wall Streeter all came out to tell us that crypto is no value. There's no store. And my point is that it's kind of an interesting moment to see what happens to the psychology. But question for you is, you still a believer?
Absolutely. I mean, I when the Bitcoin white paper came out, I read it and I just thought this is unbelievable. And I've been promoting Bitcoin, for a decade, and thinking about it. And I I did not get caught up in the frothiness of only a little bit, but not too much in the frothiness of the crypto craze. But like I'm invested in Bitcoin and Ethereum. I truly, Bitcoin initially, which I thought was just an awesome long-term play. And like, frankly, I didn't invest in it to make money, to be honest. I invested in it because I thought it was a really important technology that needed to exist. And so, I've never sold any crypto asset and I don't intend to sell anything anytime soon. And I invested in Ethereum because it felt to me like that was another awesome idea of built on a blockchain that we could build applications. And it is an awesome idea. And whether or not, Ethereum is the one that will ultimately win, or Solana or whatever, like, it's that idea that is worth investing in. So my perspective is, maybe these things will make tons of money in the future. Obviously, they have done very well, those particular two assets in the last few years. I mean, people are high. There's a lot of high speed hand wringing about BTC 30K, whatever. Like, go back 3 years, okay? It was much lower, and so was Ethereum. So, like, get over it. Think about it over a long period of time. This is a fundamental enabling technology for the internet and for the future of, like, society. It ain't going anywhere, and it's worth investing in it because we need it.
And I'm going to end on that. I could go back and do a whole crypto show with you, but I remembered the laser eyes on Twitter. I love talking about it. And by the way, you probably can talk a little more freely about crypto than about Five9.
That's just a hobby. Yeah.
But great having you, Rowan, on the show. Thanks for joining me once again on Making Markets. Can't wait to have you back soon.
Thanks, Dan.
Thank you for tuning in to Making Markets. Enjoy what you heard? Please subscribe to get every episode on your favorite podcast platform. You can also watch us on the web at futurumresearch.com/makingmarkets. Until next time, this is Making Markets, your essential show for market news, analysis, and commentary on today's most innovative tech companies.